Good morning, everyone. A very warm welcome to the MK Media webinar. Thank you for taking the time to join us today. We have with us Mr. Neerav Sheth, CEO Institutional Equity, and Mr. Seshadri Sen, Head of Research and Strategist, who will walk you through the market wrap up for 2025 and share their outlook for 2026. We are delighted to have you here. Let me now invite Mr. Neerav Sheth to lead us into the session. Neerav, over to you.
Thank you, Nidhi, for the quick introductions and a warm welcome to all of you. So let me just give you a context of what happened last year and then venture into what do we expect going into 2026. So we started 2025 with higher valuations and you had a tremendous power of earnings growth post pandemic. And obviously in the small cap and the mid cap space, you had almost a 30% CAGR. So it was just natural that nothing moves in a linear fashion ever, and you obviously expected some sort of a pullback in earnings growth, not a collapse, but some sort of pullback, some sort of moderation, which is exactly what happened. What we did not anticipate was the fact that you have been serious underperformers as compared to the global context. So, for example, if you look at your emerging market peers, Korea, Taiwan, China, then the underperformance is probably the highest in the last 3 decades. So, a lot of these markets in dollar terms are up by about 30, 40. Korea is up, I think, about 70%. And we are by and large sort of flattish. And it is obvious because you've seen incessant selling by the FIs as well. The good thing is that by and large now you've seen valuations come back to mean levels. Sen will talk about it as we move forward. But two big things have happened, and I think the markets are underappreciating the fact that India seems to be migrating into a low inflation economy. This is very, very powerful. Please understand and appreciate the fact that almost all the economies are way off their inflation estimates, right? So, I mean, at least in my 30-year career, I would not have never assumed that the headline inflation in India will be lower than that of US. So, this means that I still believe we've seen very recent repo rate cuts, but I believe that you are heading towards a higher growth rate, lower inflation, and lower interest rates as we move forward. This actually is the benchmark to which all the assets are get valued, and therefore, on a longer term perspective, you should be bullish about how we would expect the equity assets to get valued. The second thing, obviously, is decent reforms, very powerful reform in terms of GST cuts. Again, I would not try and correlate that to a short-term measure, which is, let's say, an offset to what is happening with the US-India trade deal. I believe that, at least this is my personal view, that the incumbent government takes a 20-50-year view in terms of how they want to drive the economy. Like I said, you've taken a lot of pain to try and ensure that you are cutting inflation out of the system. Your macroeconomic indicators are solid. You've done direct tax reforms. Now you are looking at indirect tax reforms. They're already talking about the fact that they want to do a serious revisit of the custom reforms. So this is a work in progress, right? So you are trying to create very, very solid balance sheet to support long-term growth rates. So that's the second big positive. Now, broadly, obviously, when you look at this, there is nothing for you to be very negative about. Obviously, there are more geopolitical risks, and I'll talk about bit later. Now, in terms of sectors, you're following what the directions the government is leading into. Bullish on discretionary consumption, because obviously these are big cuts. When you're talking about 10% price cuts, it does have a solid price elasticity. And it is not necessarily only for the next 1 or 2 quarters. I believe that this opens up the visibility for better growth over the next 2 or 3 years. We also tend to like materials, primarily cement. They have not done well at all. Uh, our base hypothesis is that cement today is where telecom was 3 years back. Using a massive consolidation, the prices have obviously not moved, but they are not necessarily driven by supply-demand economics. Eventually, once you got these GST cuts behind, I believe that you will see a significant ramp up in cement prices over the next couple of years, which will drive the re-rating. One of our contra calls has been to be underweight on financials. It has by and large played out fairly well. And that is largely because of the fact that, we believe that the segment is getting disintermediated by fintechs on one side, by bonds on other side. And this obviously puts the large cap banks at a sort of disadvantage. Within that, we are quite okay with SME banks. We are quite okay with NBFCs. Sen again will elaborate on that further. And again, a non-consensus call is IT. So one thing is obviously you've got these technical challenges about what is happening with US and stuff like that. But we believe that the pains are deeper, more structural. Our view is that the market seems to be underpricing the risk of what AI can do in terms of what percentage of codes can get automated and what it does to the pricing deflation. So there's fair bit of uncertainty, and these are very, very strong, profound changes in technology. And even if you're not very sure about the outcome, it does merit lower valuations for the same kind of growth rate. Yeah, so and lastly, like I said, the risk, I would not necessarily call it a risk. At some point of time, we'll have the trade deal done. Uh, we are hard negotiators, and we are taking the flag for that. Even then, the economy seems to be doing well. Obviously, it is a pain point for a lot many sectors, textiles, uh, seafood, stuff like that. It's an issue. But then you can't walk away from the fact that US will need India as a counterweight to China. There is no doubt about it. One of them is the richest democracy in the world. One of them is the largest democracy in the world. There is absolutely no hope in hell that you'll not move together over the next several years. So in a nutshell, just to summarize, very constructive on the markets. Fair degree of certainty that 2026 will be far better than 2025. Uh, Far more bullish on SMEs because that is where a lot of actions is happening. We've not mentioned, but we are also very bullish on the new age platform companies. They will tend to be volatile because there is always a trade-off between the profit and the growth. But they've got very, very solid competitive moat, most of them, and discretionary that I talked about. I'll take a brief pause and then maybe Sen can take through his strategy piece in detail, and then we are happy to take questions. Over to you, Sen.
Thank you, Nirav. That's a great summary of the overall position. I'll take you a little deeper into our argument, and then we'll take questions. We are looking at a Nifty target of 29,000, about a low double-digit return that we expect for CY26. Uh, Similar to what we delivered actually in CY25, I think we delivered a similar low double-digit return. Though we entered CY25 with the market correcting, and we are exiting CY25. Ignore the last month on a slightly higher note, but even then we expect a repeat of the broader low double-digit return on the broader market. Just a little bit of warning that the we think that the short term may be a little stressful. We think that the stress on the rupee, which is probably an outcome of the tariffs and the negative impact of that has had on exports, is leaving the market a little vulnerable in the short term. But it's very getting increasingly difficult to predict short-term trends. So we prefer to take the slightly longer view, and if there is any material correction, we would treat that as an entry opportunity. The key themes for FY20 is for CY26 are consumption recovery, the liquidity infusion, and lending deregulation, a mixed capex cycle, and the India-US trade deal. We are overweight on discretionary healthcare, materials and industrials, underweight on financials, IT staples, and telecom. I'll come to some of the major sectors in a little bit. Uh, by and large, we are still prefer SMIDs, because if you need alpha and outperformance, I think SMIDs is the way to go. Primarily because of two things. One, in many large sectors, and I'll name you three: IT, financials, and consumers. Smaller companies are outdoing larger companies. This is a reversal of the trend in the pre-COVID decade. The second is that this is, if you look at the actual numbers, SMID companies are delivering higher earnings growth and are improving their balance sheet. One of the big problems was with SMID companies pre-COVID was that their balance sheets were weak, and that problem has been sorted. So I know optically SMIDs look expensive, but that is where alpha will be created. One has to be careful, but in terms of stock picking, but that is where the alpha will be created. In volatile markets, large caps will provide wealth protection. Uh, One major factor is that, and we have a chart on that, is that earnings are bottoming out, especially FY27 earnings. Forward earnings consensus forecasts for the Nifty have started moving up after a, I think, 12-month gap. And that, I think, is a very positive sign for the broader markets. As I said, the key themes, GST is not just a one-time measure. There are two parts to GMT. First of all, they've closed the affordability gap at the lower end of many of these categories. Autos is the biggest one. You've seen across the auto space significant price inflation at the entry level because of various regulatory interventions starting sometime in 2018. That has pushed entry-level prices to unsustainable and unaffordable levels. The GST cut allowed that price to drop and suddenly has increased the TAM. So we are not in the camp which believes that this is a one-time festival sales, one and done kind of growth. We think that this growth will continue through CY26. We also think that other durables like ACs, for example, will also start to show growth in CY26. Because of the vagaries of the weather, CY25 was a bit of a tough year. We think that they will come storming back next year. Monetary easing, we all know what the RBI has done in rate cuts, but I would prefer to focus on the lending deregulations. As we exited 2024, banks were almost afraid to lend. They were afraid to take risk. There was this panic built up over a supposed credit bubble building up. Data later showed that there was no such credit bubble, but there was a panic built up, and the regulator was putting a lot of pressure on banks to slow down. There was a 180-degree turn from January, February onwards. Risk weights were cut. A lot of the bans that were put on various entities, which had a chilling effect on the industry, those bans were started to get withdrawn. And the message from the regulators were, please go out and do business, do not fear. A lot of recently the RBI simplified a large number of circulars. All this sort of an ease of doing business improvement in the banking sector is something that is not talked about enough. I think this will lead to a substantial leap in growth in the banking. We are expecting next in FY27 growth to touch mid-teens, somewhere in the mid-teens. RBI is trying its best to ensure there's enough liquidity. And we are not done yet on cuts. I think, the last cut and the commentary suggest, as Neerav mentioned, we are in a amazingly low inflation environment, which opens the door for further rate cuts going forward. The capex cycle had a great run between 21 and 24. It will now moderate, but it is not dead yet. Private capex at the margin is improving, though it is not big enough to move it from a macro perspective. Government spending will continue. Yes, state governments are a little constrained because of the welfare spending that they're doing, but the central government will focus on key areas like railway, defense, renewables, and the power sector, for example, will see very intense capex, and that is where even private sector is participating in a big way. So we don't think the capex cycle is over and done with. It may not show the kind of growth that it did between 21 and 24, but there still will be sustained growth in line with nominal GDP or slightly higher is what we are penciling in for overall capex growth. Um, the India-US trade deal remains an important macro trigger. As I said, we think that that is the cause of the sustained pressure on the rupee. And while the RBI is trying to do some interventions, a durable solution will be to get that deal signed. There is no visibility, unfortunately, on when it will get signed. It could get signed next week. It could take another 3 to 6 months, but I'm reasonably sure that it will get done. It is critical to both countries. I don't think the US also means to keep this tariff. They want the concessions. They want to get it done and move on. So there is, I think, enough for both sides to negotiate. As Neerav said, India is rightly negotiating hard because whatever decisions are taken now will have a lasting impact. So there is no point coming under pressure and doing a hurried deal. But I think over the next 3 to 6 months, it will get done, and it could then get done next week, and we won't know. Meaning that is one. There is everybody's keep playing their cards close to their chest on that one. So it is very difficult to put a timeline. Yeah, we can move to the next slide. Uh, as I said, GST is a growth accretive big ticket reform. It is not just a rate cut. I disagree with those who say that it is just a rate cut. First of all, it is a structural boost to affordability. Uh, Second is that uh, the lower the GST rates, the greater the compliance, the greater the ease of doing business. It is a little, it is a little onerous to the economy to be paying a 28% GST rate on any product. Where does the economics of any product support the government taking away 28% of the top line? I know there are input tax benefits, etc. But even with that, it is way too onerous to support a business. You need to have very high profit margins to be able to give away so much from the top line and still run a successful business where you're getting the price right to address the TAM, but you're still keeping enough margins for yourself and return on capital for yourself. Uh, so, um, so I think it's much more than just a tax cut. It is trying. There'll be significant procedural simplification as well, and that again that second order impact we have not yet felt. Where, for example, SMEs, their friction of doing business gets considerably reduced. Now I know you have to wait for 6 months to see how it exactly plays out. Many of these things look great on paper, when in actuality, when it's implemented on the ground, there's still there's a lot of sand in the wheels when it comes. But I at least there is an effort, and what I'm very constructive about is the mentality of the government, saying that this is a problem. We need to not just cut rates, but simplify procedures so that the SME side can actually start to grow, and that can unleash a very positive economic cycle. So as I said, it's not just the cutting GST rates. That is not a not that by itself is not reform, but it is the larger picture and the mindset of the government which leads me to call it a major piece of reform. As I said, capex cycle will no, will normalize. If you look at Exhibit 5, that's a chart that I really like, where uh, I think we have to keep our expectations of a private capex cycle slightly muted. On the ground, there are many sectors which are investing very heavily in capex, but they are relatively uh, very small part of the overall fixed asset base of the country. The ones that are very heavy, say materials, energy, and to some extent utilities, they are not growing, and that is causing a problem. Now, some of these have classification issues. For example, Reliance get classified in energy. Reliance's capex is across many sectors, and you know so it becomes difficult to capture the entire thing. But it is something that will keep the capex cycle on the private side slightly muted. So Exhibit 4 is a great illustration of that. So in FY 9 and FY 11, private capex, this is the capex of the top of the BSE 500 companies, or the top 500 companies, was 6.5% of GDP. That fell to as low as 2.2. Now it will improve from 2.2, but it will not go back to 6.5. That's the point I'm making. So yes, you will see positive momentum, but don't expect those highs. And that is great. You don't want it to go to 6.5, because at that point in time, it was private companies with very high leverage, doing projects with questionable economics, and that is the source of the banking crisis in the next year. So I don't, I would be very nervous if it went to 6.5, but it should steadily improve from the 2.2 that we are seeing at the moment. Next. Again, as I said, RBI's measures support growth. We are, I think, at the lowest interest rate since August 22, if I remember right. RBI is doing what it takes on liquidity, but unfortunately, the stress on the currency is stymieing their efforts a little bit. But RBI didn't do what it takes mode, as they proved last Friday, with a 1.45 trillion injection into the markets. The short end is seeing higher transmission in terms of interest rates, and that is a bull steepening of the yield curve, and I think that is fine. As far as the economy is concerned, most private players deal in the sub 5 year segment. Very few private players actually borrow in the 5 year plus segment. And there, a 20, 30 basis point higher interest rate doesn't really affect business plans. If you're a large utility player and you're borrowing 10-year bonds, you really don't care if it's 20, 30 basis points higher. Your project economics is much stronger. But the what acts as a catalyst is the short end. Most of your retail borrowing is at the short end, and most of your um, corporate borrowing also is at the sub 5 year level. When those rates drop, then that acts as a meaningful stimulus. So I am not worried about transmission at all. I think where it matters, there is enough transmission. We are looking at a consumption recovery. The job data in India is difficult to get, but we are seeing some green shoots in the Naukri Jobs Week Index. The big one is the unsecured lending number, and there you see from September there's a decisive turn. This is something I've been highlighting. We have been highlighting for some time that FY26 in our 25 year ahead note, we said that in FY26 you will see a turnaround in retail lending. It came in the second half, but it has finally come, and that is a very powerful catalyst for consumption growth, because whether we like it or not, a large part of consumption today depends on leverage. As I said, the credit cycle is bottoming out. We are expecting the credit growth to touch for 11% and 13% in the if you look at Exhibit 12 in the next 2 years, it will be primarily driven by retail. Uh, Exhibit 13 tells you that there has absolutely been no stress in retail asset quality. This is a data that comes from TransUnion CIBIL, disclosed on a quarterly basis. Uh, One interesting thing, and Neerav was referring to that as well, is that NBFCs are disintermediating banks on the retail lending side as well. Something that is not as appreciated as many people. Many people. The bond part on the wholesale side is people are well aware, but on the retail side, NBFCs are also disintermediating banks. Next. Yeah, earnings forecast is so the blue line in Exhibit 16, you're seeing FY27 earning EPS forecast starting to move up after an extended period of downward revision. So that I think is a very positive sign for the markets. If you saw second quarter, the share of positive surprises was much higher than in the first quarter. So that also is another positive trend. And remember, this is second quarter before the GST cut. So I would think that maybe the full GST cut has not been factored into the into earnings. And we are also seeing that the distribution of earnings growth distribution of upgrades is starting to creep up, and the share of downgrades is starting to go down. So by and large, a lot of green shoots in the overall earnings forecast, consensus earnings forecast universe. Valuation support is still not that healthy. It's, I think, more in neutral territory. Nifty is still trading at +1 standard deviation on a forward forecast. Nifty is not the best indicator. Exhibit 19 is something that we use. This is the share of the top 500 companies that are trading above +1 standard deviation, and is a disaggregated number. This tells us much more than the Nifty is, and that number is quite healthy at this point at 23%. If you notice, that number was 42% in October 24 when the market peaked and then subsequently crashed through that quarter. So from there, I think we are far better off in terms of where that ratio is. Again, a couple of the case for SMIDs, valuations are optically high, but there are some. So this is an important point that I'm making, is that the Nifty is the weight of Nifty in the Nifty, the weight of financials and energy, which are fundamentally low PE because they are asset heavy sectors, uh, is 20% higher than in the small and mid cap index. So by definition, the Nifty will trade at a lower PE than the others. So just because the Nifty is trading at a lower PE does not make it more attractive. One has to dig deeper and figure out what is the sectoral composition. And I would add IT also to that mix actually. But just these two sectors itself account for a large part of this valuation differential. And if you see Exhibit 23, you'll see that in many sectors, the PE of the mid to small cap is not that much higher than in the Nifty sector to sector. So yes, there is a little bit of premium, but as I said, some of those are growing much faster. But I think that point number two is very important when we discuss small and mid cap valuations. So we remain very constructive on small and mid cap over the longer term. We think, as I said, that is where the alpha will remain. A little bit of comment on flows. As I said, FPI net flows have been bad, and Neerav was referring to it in his discussion. And obviously, we've been sort of rescued by, if you see Exhibit 24, domestic flows. So let's go step by step on what we expect here. We think domestic flows are going nowhere. They will remain very strong. The Uh, in a low interest rate environment, especially with differentiated taxation, the Indian saver will continue to improve their exposure to equities, and I think that is vital because we are a young country without any social security. If our sub 40 age group has to build wealth to pay for their retirement, uh, then underexposure to equities is, I think, a very dangerous, would be very dangerous. So I think it's very healthy for the overall macro that the household exposure to equities is going up. Yes, the it is a bit of a worry that savers have only extreme options of go either to equities or to very low yield debt. In an ideal world, you would have to have a continuum. Maybe the emergence of REITs and InvITs will address that. But by and large, as a macro, the equity cult or the equity culture that is building up is a very big positive for India because that will help us avert any retirement crisis in 2050 and 60 when the demographics start to turn a little adverse. A lot is said about equity primary market issuance. Uh, yes, it is positive in two ways. Everybody looks at the negatives. There's so much supply. It's positive in three ways. One, you're getting a breathtaking new group of companies, meaning in the internet platform space, from having three or four, now we have 15 to 20. Some of them are very high quality companies, and we are very bullish on the space. Apart from that, there are many niche companies, there are large companies which are getting listed. You wouldn't have thought that a large MNC appliance manufacturer would get listed in India. A appliance company would get listed in India. These are companies which are delivering. It gives Indian investors in the Indian equity markets to take part in a broader swathe of the market. And then you have the NBFCs, etc. You have by the end of middle of next year, all the large mutual funds in India, asset management companies in India will get listed. That's a fantastic opportunity for retail and other investors to participate in high growth sectors, which would otherwise have been held on private hands. So that's positive number one. Positive number two is that if you are giving, there's much debate on why this is actually a lot of Ps are getting exits and this is not actually fresh capital. It doesn't matter because the exits that the Ps are getting was fresh capital at one point in time. That we are now a mature enough market to give such large exits. Can you imagine? Like, there are companies which have been fully sold to Ps or promoters which are fully exited. The Ps are getting the confidence to put money in those new companies because they get exit. So I'm not at all worrying. This is a very positive sign. Thirdly, it is absorbing the flows that are coming in and preventing the markets from overheating. And distributing the retail flows more equitably. So I'm very constructive on the IPO boom. Yes, there will be the odd IPO which gets overvalued, the odd which gets undervalued. That is fine, but we are overall, that is a very healthy sign for the markets. It's a sign of maturing markets. Move on. Sectors, Nirav ran through it. Our top overweight is discretionary consumption. We think that after a significant lull in FY24 and FY25 and parts of FY26, discretionary consumption is going to come strongly back. GST cuts, the RBI easing, and a potential job recovery next year will be the key triggers. Healthcare, we are more positive on the non-pharma side, but pharma also gives a good defensive long-term compounding exposure. Materials, as I said, cement. Last year was very weak for cement prices. It may continue for another quarter, but take a full year view, cement looks very positive. Industrials, we are significantly constructive on industrials. As I said, the capex cycle is not dead. One has to be selective there, but it looks good. Lower falling interest rates would mean that real estate look continues to look positive, and I think utilities as a sector has had a tough year. But if we take a 10-year view on Indian power, it is going to be a very high growth sector. Power availability is improving. Demand is going to come. We are going to get way more energy intensive in our growth, not just from the per household energy consumption is set to move up because as standards of living move up. And secondly, you have the additional boost that will come from data centers, etc. So yes, utilities, both green and traditional, will, I think, have a. It's not a 2 year story. It's a 5 to 10 year story of very high growth. Some contrarian negative financials. I think Neerav described it beautifully. The large banks are getting disintermediated on both ends, and that is not fully reflected in valuations. Technology is facing severe challenges on growth, and valuations are fully yet to adjust. Staples, that's FMCG companies, are also structurally losing market share. Two things are happening there. One, and I'll maybe discuss the sector a little later. Energy, we think, is not energy you buy at the bottom of the valuation cycle. It is not there. And telecom, we think that the ARPU growth that the market is building in may not materialize. Let's move on. We have a couple of slides on individual sectors. Discretionary, benefiting from multiple stimuli. Yeah, I didn't mention the income tax cuts that came in the budget, and next year will be your maybe with a little delay, but there is also a pay commission which will uh, give an additional boost once these stimuli pan out. GST aided price cuts to boost demand, and we think within autos entry level will make a strong comeback. We prefer PVs and passenger vehicles and two-wheelers over CVs and tractors. Air condition is another strong segment which we think should have a much better 2026 versus 2025. And I think earnings upgrades are yet to fully capture the upside here. There will be more upside. Industrials, we think central government capex will normalize but will continue to grow. State government will remain a little sluggish. Corporate capex will pick up, but I think I've mentioned this 2 or 3 times already. Defense remains a major opportunity, though valuations are a bit of a worry. We are structurally bullish on power. One section that's not mentioned here, I think railways, the government will continue to invest very heavily. There was a bit of a pause when a lot of railway capex was moved to from fresh capacity building, both on lines and rolling stock, towards safety. Once that has stabilized, we think lines and rolling stock will come back. The government's intent on this is quite high. Um, I won't go through this. Is a long and dense slide, but we think that there are structural challenges on disintermediation. We like the small and mid-cap banks, especially the ones which have seen foreign capital infusion. We've seen foreign banks and PE funds being allowed to take uh, strategic stakes in banks. That's a big positive for those banks and the sector because it gives them immediate capital, it gives them assurance of future capital, allows them to then, press on the accelerator and grow. We are getting into an easy liquidity environment, so their deposit franchises should hold up better in this in an easier environment. And some of these banks will get into a high teen growth cycle over the next 3 years, and valuations are yet to capture that. So, very interesting sector. Technology, we think some of the AI risk is overestimated and budgets to expand rapidly, but it is indubitable that the share of Indian IT services may decline. And the sector does discipline capital allocation. It's a trading sector. At the right valuations, it looks attractive. One more, if you look at the third last point, is that this is one sector where the mid-sized companies are doing better, and we are not We are, we would stay away from the large caps and we prefer the small to mid-sized companies in this sector. There's a complete U-turn from what was happening in the pre-COVID decade. Yeah. Do we have? Yeah, that is it. Staples, my view is that the large staples companies are buffeted by two things. One is the democratization of distribution, where the quick commerce is playing the role that big box retailers played in the US, a few decades ago, where the stranglehold of the FMCG companies over distribution is starting to weaken, and that is leading to loss of market share. Ultimately, they'll have to either sacrifice margins or working capital, and that adjustment is in place. But the top line growth weakness that they are showing is not reflective of underlying market growth. They are losing market share there, and they are sitting at very high valuations, which we think will temper down over time. So we are staying away from the entire large FMCG sector. Uh, that is broadly it from me. We can take questions.
We have two questions in Q&A. First one is, small and mid cap haven't performed so well this year and were down YTD based on weak earnings, some said. How do you think they will fare in the near term? What will change?
We First of all, small and mid cap will always be a sort of stock picking place, and there are plenty of small and mid caps which have done well. But it's right that the small and mid cap indices have not done great in this last year. In the short term, there may be continued stress because when the markets are not doing well, overall small and mid caps come under extra pressure. But if you take a 1 to 2 year view, I think, as I reiterate, that is where your alpha will be made. We have to all work much harder to find the right stocks, and certainly one has to be a little disciplined about which valuations one will buy those at. But in many sectors like financials and IT, small and mid caps are doing better than the large cap sectors. In many sectors, it is almost exclusively small and mid caps which dominate the sector. For example, non-pharma healthcare is one such. EMS is another sector that we like, and of course the platform and internet businesses, which I think is a great theme for the next 2 3 years, is dominated by small and mid cap. So we remain constructive, but yes, while this current market turmoil is going on, we think there is a risk that small and mid cap may underperform. Neerav, if you want to add any.
No, yeah, so I sort of agree. It's more of bottom-up approach. And anyway, now, even if you look at some of the carnage that has happened in some of the stocks, right, they're down anywhere from 40% to 50% from their peak. So there were pockets of ideas which were growing very fast but were similarly valued. So some comfort in terms of valuations approaching over there. But suffice to say that I believe that next year, I think as we head into next year, for the broader market itself, apart from bottom-up story, the broader markets also should do better.
Right. The other question that we had was, though domestic inflows are supporting the market amid foreign sell-offs, how sustainable is that? FIIs help in growth, and if they continue to be net sellers, how will the market see holistic growth?
So let me just take that and then you can come later. So, yeah, you should not correlate too much in terms of, the FI, if the domestic flows are holding up well, and which is why the markets are doing well and FIs are selling and all. You always have to differentiate between what is the cause, what is the impact, right? So, the cause always remains the fact that what is my earnings trajectory, right? So, if you go back long enough, 1979, the index was 100, and in 1992, it peaked at about 4,000. There was no FI flows then, right? And we have now got negative FI flows, I think, by and large for the last 3 or 4 years. So the thing to understand and appreciate is the fact that, which is what I was referring to in my opening commentary, that India is moving into a structurally low inflation environment, which means that, and your earnings are also getting less volatile. Your interest rates are coming down, right? So just like you always have got a pool of savings that gets into deposits, right? And you don't always try and argue that, oh, my interests are going to come down. What is going to happen to my deposit and stuff like that. Water will always find its own level. Likewise, it is safe to assume that a part of your savings is now structurally getting invested in equities. And as long as you've got a slightly longer term view, which is more than 3 years, I think that should hold up pretty well. Now, coming specifically to FIs, like I said, you are an unusual year this year, right? Because uh, you very, very strong AI market and AI investing opportunities outside India. And we are on the wrong side of the AI trade, right? So we have taken that flag to some extent. But obviously, you're talking about, almost now about a $5 trillion economy, very vibrant market. It is not that. The question to ask is that what happens when FI turns buyers? Because domestics are going to be there for a long, long period of time. I would twist the question and I'd be more worried about the upside risk rather than worrying about the downside risk. Sen.
Oh, absolutely, 100% agree on all that, and there's very little for me to add to that. Oh, after a long period, Indian earnings is getting revised upwards. Uh, in any other situation, there would be a rush of FII money coming in at this point in time. The only reason is that because of the trade deal and the pressure on the currency, nobody wants to enter a country with a weakening currency and have a mark-to-market loss right up front, right? And that is why I think the FII money, and it is December, so fresh allocation. So if a trade deal gets done, say early part of the first quarter, you will see a rush of FII money because the factors, and Nirav alluded to that, which kept them away last year was that Indian earnings was getting revised downwards, and there was an AI boom everywhere else. That is completely turned now, right? Nobody wants to deploy fresh money into AI in a very big way because of valuations, and there are deep question marks about AI profitability. I mean, it all looks good, but how profitable are these AI investments is a big question mark that is not yet resolved. And secondly, Indian earnings are also getting revised upwards. So nobody wants to put money in a 20p market where earnings are getting revised, so you don't know whether it's 20 or 21 or 22, right? So everything is ripe for an FPI rush once the currency stabilizes. And I think Nirav also said something very important. It is our job to discuss the future of flows, but markets react to two things: earnings and valuations. Flows are a consequence of that. Flows are not a cause of earnings and valuations. So if the earnings valuation mix is right, it doesn't matter where the flows are coming from. And that we proved in the last 2, 3 years when FPIs have stayed away and the market's broadly done pretty well. So, completely agree. I think we need to think about what will happen when FPI money start to come in. And I think one thing that also is, we've seen a 2 year period when PE money has largely exited, but the PEs are raising a lot of fresh money on top of that because their experience and the IRRs that they've delivered on those investments are huge. So there is going to be in the next 1 to 2 years another round of fresh PE money which will come in, and that also I think has not been factored into the overall calculations when people are thinking about the market. So no worries on flows whatsoever.
Mayur from Mint has a question which I think has largely been answered, but I'll still say it out in case you want to add something. After a year of heavy FPI selling, do you expect foreign flows to turn positive in 2026? What would be the key triggers for a reversal?
Sen. I think you almost
Yeah,
answered that,
yeah,
but
I
yeah.
think I've answered that. I think we expect CY26 to be a strong year for FPI flows for the reasons I just said. India's earnings is getting revised upwards, and I think there's further upward revision which will happen in FY27 earnings. And The rest of the world, the relative attraction of rest of the world will also start to come down. If you see the Fed statement yesterday, they are warning of a very severe jobs problem in the US. That will put not just the US. If you look at all the other markets that Neerav was referring to, they all live off the US market, right? I mean, India is a inward looking economy to that extent. So if US slows down, if US catches a cold, all these markets will start sneezing. And there, when you find a country where earnings are getting revised upwards, it's just that we need to ride out this 2 or 3 month period when the currency is wobbling because of the trade issues. Otherwise, I think for full year basis, it will be a very good year for FPI flows.
MK is overweight on discretionary industrials, healthcare, and materials. The discretionary expected to be the strongest theme in 2026. Which three or four sectors under this theme can outperform in 2026?
Autos, where we prefer passenger vehicles and two-wheelers. We would also selectively look at the high quality EV companies in two-wheelers. Then consumer durables, I think ACs is one segment I expect to do well. Low base and significant GST cuts. As long as we don't have another weather shock, if we get a reasonably warm summer, I think you will get a big bounce back in the AC segment. Internet driven consumption themes will continue to do very well in next year. That is across quick commerce, retail, the entire, there are too many, each company is a segment by itself. So that is the third segment that I think will do well. The one to keep an eye out for is value retail, value apparel. That has seen after an extended period of slowdown, we saw some of the value apparel companies start to deliver growth last year. I would sort of watch out. We're just getting some negative feedback that the weak, the flip side of low inflation is that weak crop prices are affecting rural consumer demand. So that is to watch out. I wouldn't dive into those. We would watch out for that. But if that decisively turns, there's a long runway of growth there.
Are bullions still poised to outperform equities in 2026?
Sorry, that is what bullion.
Oh,
Yeah,
gold, yeah.
bullion, gold. I think largely gold is what they're trying to
So
understand.
you had a very solid run, and I think that you should not look at gold in isolation. At least as far as our understanding is concerned, that given the kind of uh, uh, so you should look at gold as a quasi dollar debasement theory, right? So the kind of steps that have been taken by US in terms of they've started becoming more inward looking, right? In terms of having very high tariffs on a lot of the commodities, aluminum, steel, and stuff like that. Now that is actually an emerging market doctrine. It's not a developed economic doctrine, and they've done phenomenally well by keeping very open borders. This has implications eventually, and the implications are actually reflecting in how the dollar is behaving, and therefore the contra to that is what you are seeing in gold. And the one way it plays out is obviously most of the central bankers are including India, they are increasing their gold buying significantly because you've seen the US reserves being forfeited, so no countries want to be in that space at all. So very difficult to figure out what we'll do in 2026. But to me, this is a counter trade to dollar, and we are bearish on dollar. So you should have a constructive outlook on bullion. Sam, if you want to add something.
No, I largely agree. No, not my favorite asset class, but the reality is that it does serve a purpose in your portfolios. And as long as the US government is adopting the policies that it currently is, there will be continued pressure on the dollar. And uh, I don't think the global central banks are done yet in terms of diversifying away from the dollar. And you know uh, so I there is a likelihood that gold will continue to do well. It does look a little scary if you look at the chart.
Yes.
but that is the way it is. Very difficult to forecast gold. It's just that I wouldn't, completely ignore it as an asset class. I think some exposure to portfolios is essential as a hedge to everything else that goes on.
Thanks, Ishadri. I do not see any further questions. And I think we
So
are in.
done with the time, I guess.
Yes. And so thank you, everyone. Thanks for taking the time to join today's webinar. In case you have any further questions, you can write to media@mkglobal.com. We'll be happy to answer those. We will be releasing the press release shortly after this webinar. Thank
Thank
you
you.
once
I
again.
appreciate it.
Thanks.
Thank you so much. Thank you, everybody, for your time. And as Nidhi said, please reach out if you have any follow-ups.
Thank you.